Times Square. Big old Yahoo board. Maybe Aaron Task will invite me on. And that's where I'm headed, the NASDAQ, to be on BNN News. Here I am in the recording booth. How cool is this? Got the camera, and there we go. There's NASDAQ.
A note that caught our eye from runtogold.com, saying the gold price rise portends another round of the credit crisis. Gold in Q2 2010, $1,300. Joining us to talk about that prediction, Trace Mayer, financial blogger and author of The Great Credit Contraction. He's in the city so nice they named it twice New York, New York. Great having you with us, Trace.
Oh, thank you.
You say the credit crisis has not been calmed but intensified. Why?
Yes, a couple of the reasons is that the FASB mark-to-market has just obfuscated the toxic assets, and so it's prevented the credit liquidation. So we still have the same bad assets that haven't been liquidated in the market on the balance sheets, but people don't necessarily know where they're lurking.
So the idea that stimulus packages, government backstops, things of that nature have really delayed the inevitable more than anything else?
Yes, they've delayed it. They haven't, and they've just pushed it off. And because people continue to make misallocations of capital because of that government intervention, it'll only lead to a bigger crisis later.
Okay, when is later, though?
Well, we've been pushing this off for decades now, and it seems to have really picked up in 2007, but the next round appears to be coming pretty soon, mostly because of the move into gold. We see it closing at $10.50 this week, and it's now got a 3-week moving average above 1,000, and so there's a lot of strength there. And the reason is because gold functions as a currency.
Really the only currency that doesn't have obligations?
Yes, it's the only currency that at all times and in all places remains money. And there's a difference between money and currency. And so gold is money because it can never become worthless. As you say, it's no one's liability.
What's really moving gold on a day-to-day basis, though? More speculation than actual demand. Is that accurate?
Yes, there's lots of speculation along with the central bank gold price suppression scheme, because gold is a competitor to their fiat paper franchises. They have a heavy vested interest in interfering with the gold market. So in the short term, we do see lots of central bank interference, but now it appears that Greenspan's call, which is suppressing the price of gold leasing gold should the price rise, his call has been counteracted now by the Beijing put, which appears to be putting quite a floor in the gold market.
You've got an interesting graphic in the report of the day, this inverted pyramid. Explain this to us.
Yes, this inverted pyramid is the liquidity pyramid that shows the different assets in the world economy. And what's happened over hundreds of years is capital has moved up the pyramid into less safe, less liquid assets. And that was the great credit expansion. But now we've reached the top, and economic law shows that capital will move down. And that's the great credit contraction. So capital is moving into safer, more liquid assets. For example, it's moving out of auction rate securities or commercial mortgage-backed securities and into treasury bills. And eventually it'll move from treasury bills into the monetary metals. And the reason for that is that fiat currency and central banking they're barbarous relics that aren't really needed in the information age. We can have gold and silver and platinum circulate as currency in ordinary daily transactions very easily. So we don't necessarily need these archaic devices anymore. And it'll take some creative destruction for that to happen. But I think that the market will pull through because there are more efficient ways of handling our currency in our ordinary day-to-day transactions.
So as we get more and more concerned about the top of that pyramid, the derivatives play, you're talking about $1,300 bullion. How do you get to that figure?
$1,300 bullion, you'd look at the 200-day moving average and where gold's consolidated and where it goes based on the usual uplegs. And so it looks like we're following the same thing that happened in 2004 with the rise in 2005, the consolidation in 2006, which led to the rise in 2007, and the consolidation in 2008. It looks like it'll lead to a similar rise in 2009 and 2010, which will take it to 1,300, which would be a little bit above its 200-day moving average, but in the same trading ranges as we saw in 2005 and 2007.
We've got a 10-year chart on the screen here, but you look back even 5 or 7 years ago, more so I suppose, take it back 10, 20. You're looking at, on an inflation-adjusted basis, gold is dirt cheap by comparison.
Yes, the reason for that, we hit on it earlier, was Alan Greenspan testified twice before Congress that central banks stand ready to lease gold should the price rise. And the reason that central banks leased gold since the early 1995 and onward, and actually before that they were in the market, is to keep the interest rates suppressed. And so we've had this inflation in the system, the consequences of it masked through the gold price leasing that central banks have engaged in. But it seems that the central banks are now losing control of their physical bullion, and the market is asserting itself, and we're seeing this rise in price as a result of it. Because when you own gold, in effect, you're fighting every central bank in the world.
Are we also not fighting the U.S. dollar? What's your expectation, Trace, for the greenback?
That's a very excellent question. The dollar is the world reserve currency, but as Alan Greenspan said, this rise in the gold price is the first real step towards a move away from fiat currency. And so we don't know how long it'll take, but the dollar has tremendous problems with it, and it's now appeared to become the carry trade currency. So we're seeing a lot of people sell the dollar to fund purchases of other assets, and that puts further selling weakness on the dollar.
All right, Trace, we appreciate you.
And will probably persist for a long time, just like the Japanese yen.
Well, we're going to leave it there. Thank you so much for your insight, and all the best for the Columbus Day long weekend.
Oh, thank you. You too.
Trace Mayer, a financial blogger and author of The Great Credit Contraction, joining us from the NASDAQ.
Oh, this is so cool. Market close at NASDAQ. How sweet is this? The NASDAQ. Look at that, the big board. That's the big board at the NASDAQ. And all the cameras. Well, they're filming some garbage, so I can't go and see the stupid bull. I think that's bull.